8% mortgage rate, wow. Picture this, a whopping 8% mortgage rate. It sounds unbelievable, doesn't it? But it's a reality that could have a monumental impact on the housing market. Let's wrap our minds around this for a moment. 8%. That's a number we've not seen for a while, not since the days when mobile phones were the size of bricks. It's a shocking change from the historically low rates we've been used to. We're talking about an era that saw mortgage rates plummet to record lows, allowing countless individuals to achieve their dream of homeownership. Now imagine that dream being shaken. It's like a cold splash of water in the face, isn't it? You're suddenly looking at a higher monthly payment, a longer repayment period, or maybe even having to reconsider that dream home you've been eyeing. But why does this matter? Well, an 8% mortgage rate isn't just a number, it's a game changer. It can turn the housing market on its head, creating a ripple effect that touches not just homeowners but also buyers, sellers, investors, and even the economy at large. And it's not just about the dollars and cents. It's about the dreams and aspirations of countless individuals and families. It's about the decisions they make, the sacrifices they endure, and the future they envision. But before we get carried away, let's take a step back. Let's understand what a mortgage rate is, why it matters, and how it ties into the larger picture of the housing market. Because, my friends, knowledge is power. And in a world of 8% mortgage rates, we could all use a little more power. So, buckle up as we dive into the world of mortgage rates and their influence on the housing market. Before we delve into the impact, let's first understand what a mortgage rate is. Picture this. You're about to buy your dream home, but unless you've got a money tree in your backyard, you'll probably need a little help to cover the cost. Enter the mortgage. This is essentially a loan you take out to buy property or land. But like any good thing in life, it doesn't come free. The lender, typically a bank, will charge you for borrowing their money. This charge is what we call a mortgage rate. Now, the mortgage rate isn't some arbitrary number pulled out of a hat. It's determined by several factors. First up, we have the economy. When the economy's doing well, people are more likely to take out mortgages and rates tend to rise. Conversely, in a struggling economy, rates often drop to encourage people to buy homes. Next, we have the lender's risk. If the bank thinks you're a risky bet, maybe because of a low credit score or unstable income, they'll likely charge a higher rate to offset their risk. Then there's the type of mortgage. Fixed-rate mortgages have the same rate for the entire repayment term, giving you predictable monthly payments. Adjustable-rate mortgages, on the other hand, can change over time, typically starting lower than fixed rates but with the potential to rise or fall. Lastly, we have inflation. Higher inflation usually leads to higher mortgage rates as lenders need to ensure they're making a profit in real, inflation-adjusted terms. So, who does the mortgage rate affect? Well, it affects anyone buying a home with a mortgage. A higher rate means higher monthly payments, and over time, that can add up to a significant amount. It's like a snowball rolling down a hill, growing bigger and bigger as it goes. Now that we have a basic understanding of mortgage rates, we can explore their impact on the housing market. Mortgage rates might seem like just a number, but they hold immense influence over the housing market. This influence stems from the fact that mortgage rates directly impact the affordability of homes, which in turn affects the decisions of potential buyers. So, let's break down how mortgage rates affect the housing market. Picture mortgage rates as the cost of borrowing money to buy a house. When the rates are low, it's cheaper to borrow, making homes more affordable. This often leads to an increase in the demand for houses, driving up the prices. Conversely, when the rates are high, borrowing becomes more expensive, causing a potential decrease in demand and a possible drop in prices. Now, let's take an example. If mortgage rates rise to 8%, for instance, the cost of borrowing increases. This means that the monthly payments for new mortgages would be higher. As a result, some potential buyers might decide to delay their purchase or look for a less expensive home. This can lead to a decrease in the demand for houses, especially those at the higher end of the market. On the flip side, those who already own homes might decide to hold on to their properties rather than selling and taking on a new, more expensive mortgage. This could potentially lead to a decrease in the supply of homes on the market. However, it's important to remember that the housing market is influenced by a multitude of factors, and mortgage rates are just one piece of the puzzle. Other factors like job growth, income levels, and demographic shifts also play a significant role. So, while higher mortgage rates can potentially slow down the market, they don't necessarily lead to a crash. In essence, mortgage rates act like a lever, pulling and pushing the housing market in different directions. They influence the decisions of both buyers and sellers, shaping the overall dynamics of the market. As you can see, a rise in mortgage rates can send ripples throughout the housing market. It can affect everything from the prices of homes to the decisions of buyers and sellers. So the next time you hear about a change in mortgage rates, remember, it's not just a number. It's a powerful force that can shape the housing market in significant ways. Now, let us imagine a world with 8% mortgage rates. Picture the housing market as a teetering house of cards, and an 8% mortgage rate as the gust of wind that could shake the entire structure. The aftermath of such a scenario is significant for both home buyers and the housing market. To begin with, let's consider the plight of the average home buyer. With an 8% mortgage rate, the cost of borrowing to buy a home skyrockets. For example, on a 30-year mortgage for a $300,000 home, the difference between a 4% and an 8% rate is over $200,000 over the life of the loan. That's a staggering amount of extra money. This increased cost of borrowing can price many potential home buyers out of the market. Those who were once able to afford the monthly payments at a lower interest rate may now find it out of their financial reach. This could lead to a decrease in demand for homes, particularly in the higher price brackets. Now let's turn our attention to the housing market. As demand for homes decreases, so too does the price. This is basic supply and demand economics. If fewer people can afford to buy homes, sellers may be forced to lower their prices to attract buyers. This could potentially lead to a drop in home values across the board. But the effects of an 8% mortgage rate don't stop there. The housing market is a significant driver of the overall economy. When home prices fall, homeowners feel less wealthy and may cut back on spending. This can lead to a slowdown in economic growth. Additionally, the construction industry could take a hit as well, as fewer new homes are built due to decreased demand. Furthermore, higher mortgage rates can also impact the rental market. With home ownership out of reach for many, more people may opt to rent instead. This could lead to an increase in demand for rental properties and potentially higher rent prices. In the financial world, the ripple effects of 8% mortgage rates would be felt far and wide. Banks and other lenders could see a decrease in their lending activity. This might lead them to tighten their lending standards, making it even harder for people to get mortgages. So, as you can see, the potential consequences of an 8% mortgage rate are far-reaching. It's not just about paying more each month on your mortgage, it's about the potential for a chain reaction that could shake the very foundations of the housing market and the broader economy. An 8% mortgage rate could reshape the housing market as we know it. But remember, this is just a scenario, an exercise in imagination. It's crucial to stay informed and prepared, as the financial landscape is ever-changing. Scene script. Faced with an 8% mortgage rate, how should potential homebuyers respond? Well, it might seem like a tough situation, but don't worry, we've got some strategies to help you navigate the high-rate mortgage market. First off, it's crucial that you understand what this rate means. An 8% mortgage rate is not a death sentence for your home buying dreams. It merely means that it's time to buckle up and make some wise decisions. Your first step? Evaluate your financial health. Can your budget handle higher monthly payments? If not, it might be time to reconsider your home buying timeline. It's okay to delay your plans until the market becomes more favorable. Remember, it's better to wait rather than burden yourself with payments that stretch your finances thin. Next, let's talk about down payments. In a high-rate environment, a larger down payment can significantly reduce your mortgage payments. It might be a good time to save more before jumping into the market. However, don't drain your savings completely. Always have a safety net. Third, consider the length of your mortgage. Yes, a 30-year mortgage might have lower monthly payments, but you'll end up paying more interest over time. If you can afford it, a 15-year mortgage might save you thousands in the long run. Another strategy is to consider adjustable rate mortgages, or ARMs. These loans have a fixed rate for a few years, then adjust annually. If you believe rates will drop in the future, an ARM could be a good bet. But remember, this strategy does involve a level of risk. Lastly, shop around. Different lenders offer varying rates and terms. Don't just settle for the first offer you get. Compare multiple options to ensure you're getting the best deal possible. Remember, buying a home is a significant financial decision. Don't rush it. Take your time to understand the market, evaluate your options, and make a decision that suits your financial situation and long-term goals. Consulting with a financial advisor can also be helpful, providing you with personalized advice tailored to your needs. While an 8% mortgage rate might seem daunting, with the right approach, you can still find your dream home. And always remember, the housing market is a cyclical beast. Rates go up, they come down, but with patience and smart planning, you can navigate any market condition. So, there you have it, the surprising impact of an 8% mortgage rate on the housing market. We've delved deep into the world of mortgages, and it's fair to say we've learned quite a bit. Let's take a moment to recap, shall we? We've dissected the concept of a mortgage rate, breaking it down into its simplest form. It's not just a percentage, it's a key factor that determines the cost of your home over time. Then, we took a step back to view the larger picture, examining how mortgage rates, like the shocking 8%, can send ripples through the housing market. We saw how it influences the buying power of individuals, and can even sway the tide of the entire market. We've also walked through the aftermath of these rates. It's not all doom and gloom. Yes, there will be challenges, but also opportunities for those who know where to look. And finally, we discussed how to navigate this high-rate market. We emphasized the importance of being prepared, of having a strategy, and of understanding that the rate you start with isn't necessarily the rate you end up with. Now, why is all of this important, you may ask? Well, it's simple. Understanding the dynamics of mortgage rates allows you to make informed decisions when considering buying a home. It enables you to predict trends, to plan accordingly, and ultimately, to protect your investment. Remember, knowledge is power. The more you understand about mortgage rates, the better equipped you'll be to navigate the housing market. It's not about fearing the number, it's about understanding it. So keep seeking knowledge, keep asking questions, and never stop learning. That's the key to thriving in any market condition. Don't forget to subscribe for more insightful content like this. We're here to guide you through the complexities of the housing market and beyond. Until next time, stay informed and stay savvy.